Hello, this is Brian Overby. I am the author of the Options Playbook, and I will be your host for about the next 25 minutes here on Options Guy TV. Welcome to 2024. Last week, we went in and looked at a SPX trade in a very short-term butterfly. And on Friday, I actually had a show that was taped that covered the basics of option pricing. So that was our I actually did two different education pieces. We did one on the basics of option strategies and then went in and did option pricing. So we ended up doing two educational videos, but in the middle we actually did a long call butterfly trade that was 100% neutral, just kind of looking for nothing to happen as we went into year end on in the SPX. And guess what? Nothing did happen. So riding it into the year end, the markets were just a little bit of choppy, was a little choppy. There were many opportunities to get out. And I'm actually going to, right now, I'm showing the Trade Hawk paper trading platform because our goal today is to sell a few calls ahead of earnings on some of the deep into money calls that we have inside the portfolio. So we're going to sell a few calls today on a few stocks. Earnings season is getting ready to heat up. Markets are having a little bit of a sell-off, which was not unexpected, right? The markets have been so strong for the entire month of December that very overall the SPX had a great year, up around 20% for the full year. And selling off going into January kind of makes sense. See a little bit of give back, a little bit of profit taking that's driving the markets. But once again, the Fed, what's really sparked this is the possible rate cut that the Fed has been, I should say the Fed futures are suggesting by looking at the CME Fed Watch tool. As of today in March, there is now a 64% chance of the Fed actually cutting rates by a quarter point. Going into the most recent Fed fund meeting, right now they're still showing a very high probability that they're going to do nothing. So, but sooner than later, if the Fed futures are correct, the Fed is looking to cut rates, and that has really made the market skyrocket. We still have a lot of geopolitical concerns going on. We're going to have the jobs report on Friday that I think is going to be closely watched. We had some data out today, but in general, I think this is just a normal, healthy sell-off of the marketplace starting the new year. And because of that, and I do kind of anticipate that to continue to happen, I've decided that I want to sell a couple of call options on some of these positions that we have inside our paper trading portfolio. So I can't pull up the SPX. I can pull up the trade that we put on Wednesday. So we had one live show. I'm still traveling, so you don't get to see my ugly mug right now. And that's the way that we did the show on Wednesday, right in the middle of the Christmas holiday and New Year's. And so that trade that we did, I'm gonna run to it right now. So very quick tab here. And here is the trade. Well, that's actually the SPXW that we were looking to do. Let me grab the other trade that was there. Oh no, that is correct trade. What was I thinking? Okay, yeah, SPXW. So the W was the expiration on the Friday. So the SPXW means that it is that it will trade all day on Friday, the 29th, the last trading day of the year. And we bought the 4760s, sold two of the 48. And then let me blow this up because I know that this is a tough screen to work with today. I just have my laptop with me. So we're buying the 4760, selling two of the 4780 calls, and bought one of the 4800s. And the biggest emphasis here is the big round number around 4,800. I didn't really think that the market could break through that level. I figured that was going to give a little bit of resistance to the upside. We are a little bit overbought. We're getting a little extended relative to the 200-day moving average. So just thinking that the market might just hang around in this level, we put this entire trade on for $3.90. That's about where the midpoint was at. If we called it $4, the math is simple in that we have a 20-point wide butterfly. Means for every 1x2x1, the maximum that it could trade for is $2,000. And on a one unit butterfly basis, you're talking about 2,000 minus 400 means that we have $1,600 of profitability potential. Now, if you're trading butterflies, you're never trying to get the home run. You'll gladly take it on a one lot. I'm just gonna put it in for $400. I'm gonna sell it off for probably 8 if it gets in that range, and it definitely did. We closed the market, so if you just put it on and blindly let it ride, which I wouldn't ever suggest doing, but if you did that, you had limited downside risk. It was only the $390, which we're just going to round up to $400 was your maximum risk on that trade if you just did a 1x2x1. And the market actually closed on Friday at 47.69. So if you, and this is one of the benefits of index option trading, in particular the SPX, is if you did nothing, all that happened was cash went into your account. The cash would have been around $9 because I didn't put the decimals in, but the close was 47.69. It actually opened on Friday right at our short strike. It opened at 47.82. Yeah, 47.82, and then we went up to as high as 47.88, and then we came back down, but it sat right at 47.80, which is our middle strike of our butterfly for some time. So you could have gotten out probably even better off than the 9 points that it would have traded for at expiration. At expiration, it was 47.69. That means that call option would have been 9 points in the money. It was a simple trade, managed risk. I would have put it on for $4 if I had a big position on. And to me, a big position would probably be a 10 lot in this because it's very speculative, very short term trade. If I would have had that position on and the market went down, I would have got out of this trade at around half. If I would have lost about half of my money in this position, right down around $2, that didn't really happen. On the upside, well, at least from what I saw in the markets, it didn't happen. It never started trading south of $2. And then on the upside, though, I'm always looking to try to get a double. And if I could get a double on this would have traded for $8. I would have traded out of it. And I probably would have been out on that Thursday because the markets, like I said, were a bunch of chop. And then on Friday, they kind of settled in right in the middle of our butterfly. So, interesting paper trade that we did, all based off of where the markets were at. The fact that you could put this on a Wednesday at 11 o'clock Eastern time and have a 20-point wide butterfly and be able to get that trade off for $4 or $400 for that 20-point wide butterfly just shows you how much time decay is in those option contracts. The market at the time was 47.72, so right in between this strike and that strike, and that's what I mentioned on Wednesday. If you're trading in the SPX, a ton of time, you can look at the theory, the theoretical, the theta, all this stuff, but all I really know from years of trading is that From Wednesday to Thursday, a lot of time premium comes out of the SPX options, and then obviously from Thursday to Friday. So they really hold their value well all the way up until Wednesday. If you're looking at a weekly trade, we've done a lot of long call spreads in the month of December here on Options Guy TV, where we were doing those trades on a Monday. And like I said, the SPX holds its value a lot until Wednesday, and then things start to happen Wednesday and Thursday going into Friday. And one of the things when I'm trading a weekly expiration in the SPX, I usually want to make that adjustment on Wednesday. And if it goes all the way to Thursday, there's usually not much to adjust. A lot of the time premium will start to come out. Sometimes you can still pull off an adjustment, but that's basically the moral to the story. The SPX is one of my favorite underlyings to actually trade in, especially if I'm looking at an advanced trade like a butterfly. Okay, so now let's get back to the paper trading portfolio. So I'm going to have to, and I apologize that I have to tab over here, but now we're in the live paper trading app that TradeHawk offers. And this is one thing that's awesome about the TradeHawk software is that the paper trading app looks exactly like the real platform. Has a lot of the tools that the real platform does. One of the things it does not have though is quotes in a lot of the major indexes where you have to pay for those quotes, like the Russell 2000, the S&P 500 index. Those are vehicles that actually the exchanges own them. They're proprietary to the exchange that they trade on. And because, well, the Russell actually trades on a few exchanges, but because of that, in general, they will charge for quotes in this day and age, which I still find befuddling to me. So in the paper trading app, this is our portfolio that we've had on. Everything is done pretty well. We had Caterpillar, and that's down today, but we got pegged on Caterpillar because we sold a call against it and basically not following the portfolio every minute of every day. The options went up and got called away from us, and we got pegged on that position. So we now have all of these positions where we are long option contracts that we are doing deep into money options as an alternative to buying the stock outright. In Google, we have 4 option contracts. We added Home Depot and Lilly recently. We also have NVIDIA and Schwab. We will add a few more of Home Depot and Lilly, and we'll probably add one more position in this portfolio. Probably be United Healthcare I was thinking about doing, but we're going to try to manage this portfolio throughout. And I'm going to be setting up an Excel spreadsheet to track it a little closely. But over the next month, we want to get $100,000 of fake money in these positions, and we're going to try to manage it and just see what we do for the year. So we started off kind of, for lack of a better term, just dipping our toe in the water, right? We knew after September and October of last year, we wanted to get bullish on the markets. So this is the way that we determined that we wanted to do it. And we're going to try to actually execute some of our call options in that. We're going to have alerts, or we're going to set up trades where if the marketplace ever gets to some of our short calls, we're going to get an alert and we're going to roll those positions. Then on top of it, if we're looking at these trades, big thing is we want to try to sell some calls, turn these trades into a fig leaf, otherwise known as a leverage covered call. In the playbook, we call it a fig leaf. But we want to be cognizant of big events. And guess what's happening? Soon we're going to be having JP Morgan kicking off their earnings season, and that's the 12th of January. Then the big cap tech, we see Netflix is usually the first one in that space to announce, and they're announcing on the 23rd. The Google, I didn't get a hard number on Google by looking at it. I tried to go into investor services, see, but I didn't have anything that was officially printed by Google, but they're looking at somewhere around the 31st of January. So it's after Netflix, which is normally the case. Usually in 1 week, you have Google and Amazon and Apple. They're all announcing in the same week. Then we have Charles Schwab, which is part of our portfolio, and Schwab is on the 16th, and then Eli Lilly goes all the way out to February. So I kind of want to avoid the Schwab position. That position, we're actually up about 23% right at this point in time. I think there's going to be a little bit of profit taking it, but I don't want to sell a call going into their earnings on a shorter term basis. I'd rather just let it ride. I feel like we're too close. There's not enough juice in the options contract to really make it worth our while, and we'd have to watch it way too closely. So the one stock that we still got some time that we can do that we do get some premium for is in Google. So we're going to go to the options grid, and we're going to look at Google right now. So the expiration, we know on so we got the implied volatility right here trading. These short-term options are trading at about a 25% implied volatility, looking at the most at-the-money option contract, 25.64, which is highlighted inside the TradeHawk options grid. On the left-hand side, we have calls. Let me get some more room here since I'm just on my laptop. And on the right-hand side, we have puts. Now, if we go out to February 2nd, we can get a good feel for when this earnings report may be. We'll see what the marketplace thinks, because if we go out to February 2nd, we see an implied volatility of 30%. We go out to January 26th, and we're back around the 25%. So, looking at the earnings reports from some of the news vendors, they were saying they gave a range right around the 31st. The marketplace is saying that range is fairly accurate. Maybe it is on the 31st. We'll see. But that is the 26th February 4th, and it's just quite simple. See if the marketplace believes you. Implied volatility is going to go up in the month that they are actually or in the expiration that they're actually announcing earnings. So 26th, we're trading at 24% on the at-the-money option contract. And in February, we're trading at 30%. And then if we go to the 9th, we should still be right up around that 30% level. And we are. All right. So let's sell a call. So we're going to execute this inside this paper trading portfolio. I know I have my little mug over here. Well, 1 second. So I want to pull the order ticket up and pull the events down. Okay, so we are going to go out about 1 standard deviation, and we can do the 19th. We don't have to mess too much with earnings around the 26th because there's enough juice in these option contracts. But so right on the 19th, we're looking at about a 22% implied volatility. We're going to go out to the 1 standard deviation move, which the TradeHawk software is highlighting that this is about a 1 standard deviation move, and that kind of makes sense. We see 145.50. I don't want to trade that expiration. I don't like that 50-cent strike. So 146 is right here. Looking at the delta, that's around 16, and that should be about a 1 standard deviation move. So we're somewhere in that range. Delta gives you a hint on a 1 standard deviation move, about a 16% chance that the underlying stock by that expiration date, or on that expiration date is a better way to say it, will be trading at a 60% chance it's at least 1 cent in the money on that expiration date. All right. And on this trade right now, we're seeing it trading at 55 cents. If we go out to the 26th, I want to see where we're at on the 26th, but we're probably just going to hit this bid and try to lift that. Let's look at the 26th, though, and see if we stay right at that strike. No, we got to go up a little bit. 146. So 146, you're hitting 99, getting $1 for that trade. But notice the delta has changed. Here's the 16 delta, very close on the 148 level. The highlighting has changed inside the grid. It's because we got another week. So the probability of it going up higher on the upside and on the downside, remember that it's a 1 standard deviation move has no regard to direction. You got more time for that to possibly happen. So you're looking at a 148 strike. So if we wanted to stay a 1 standard deviation away, we're just going to get a few pennies more, about a dime more. And I'm not that excited about that concept. We're going to sell. So we're going to go back to the January 19th expiration, 16 days away. And we're going to go up to our 146 strike. And right now we see that asking 55 cents and bidding 54 cents. Quite simply, we're going to enter that trade. We got a very obvious tight market, which you would expect. I'm just going to hit the bid, especially in a paper trading portfolio. But we do need to know this. We need to know how many option contracts we have in the account. So if we go back and we look at it, we did bump our position up to 4 contracts. So I want to hit all 4 of them here. I don't want to trade after earnings, so we're going to add 4 contracts in to this position right here. 1, 2, 3, 4, and 54 is the bid. We'll hit it at 53, and we'll hit send. So we're sending an order to sell 4 short calls, 146 strike calls with the January 19th expiration in Google. And we hit yes, and we send that to the floor. Now I'm going to pull this up because my mug is in the way, but this is the way the order looks. Sell to open, 4 contracts at a limit price of 53. Status is we filled all 4 at 53. We run back to the portfolio. I'm going to put this back down and look at the portfolio. And there they are, the 146 strike calls. So one of the biggest things that we got to note now, we're at 138 in Google. We got 16 days, I think it was the number of trading days, a number of days until that expiration date. And we're going to have to make sure that if it gets anywhere close to the 146, we're going to want to roll this position. We definitely don't want to get pegged on it. All right, so now we can go down. Other one that we can look at, and I think we'll look at this trade today. And we got 3 of the NVIDIAs. NVIDIA is one of the last of the Magnificent 7 to announce earnings, usually during the earnings season. So we're going to have some time in that underlying. I think let's do NVIDIA. We got the 3 positions then on Lilly and Home Depot. We're going to probably add a couple of more positions to that trade. And like I said, I don't want to mess with Schwab. So let's go back to the options grid. And I'm going to pull this back. Oop, I don't want to do that. I want to pull this back down and click on options grid, NVDA. And we'll stay in that same expiration, January 19th, and want to make sure it's highlighted. I always want to double check because I have done this before where I sold something in I was thinking I was in this expiration, but I wasn't. I had something else clicked, and want to make sure by looking inside the software that this is the expiration date that we want to focus on. We're going to get a lot of juice, 33%, $400 stock. So we're going to be able to bring in some real coin on this one. Market is now trading at 512 and a half. Market is at 4806. So the 1 standard deviation move, and we're looking over here. We got the 16 delta right at the 515. We're getting enough juice that I think I'm going to do the 520s. And one of the things about NVIDIA is it's really struggled to get up over the 500 level. So I feel comfortable going above and beyond that. I actually wouldn't mind selling this and bringing in some premium. But here's one of the things is that if we're doing the fig leaf, where we're selling calls against our deep in the money surrogate for that underlying stock, if we're doing that trade, I always want to err to going further out in strike on our call position, getting less premium and having a lower probability of the underlying stock actually reaching that strike. So 515, I think I'm going to do the 520, as I mentioned. So we're going to click on this. And if we run over to the portfolio, we had 3 contracts in NVIDIA. So let's go back to the options grid. We're going to click on, and I'll scroll back up here. Let me get this up. 520 is what we're going to look to do. And I'll pull this on up. And here we go. 520, 3 contracts. I lost my order ticket. There we go. All right, so inside our portfolio, let me pull this over so that my mug isn't in the way. And we'll lift this up to there. All right. So we're looking to sell three of the NVIDIA 520 strike calls with the January 19th expiration. Got a little bit of fluff in here, but a pretty decent market. 225 on the bid, 227. We'll go 226 and we'll hit that and we'll send that to the market and see if we can fill. Do you want to send your order short call NVIDIA 520 call with the January 19th expiration? Answer is yes. And order sent successfully. And we'll see if we filled on that trade. So we are still open on that trade. So I'll let that one ride. I'll watch it here for just a minute or so. And at this point in time, because I'm working with one screen, if you did have any questions, please let me know inside that chat box and I can address them. But if not, no worries. We're going to be here every Monday, Wednesday, and Friday inside the Tradier Hub and on the Tradier YouTube page. And want to make it as interactive as possible. One of the big benefits of Options Guy TV is that we're using live markets and putting in real trades in those live markets. And so if you have any questions during the show, we want to make it as interactive as possible. So thanks everybody for coming to Options Guy TV, and we'll see you this coming up Friday at 11 a.m. Eastern time for the next edition of Options Guy TV.